Now, let's get right to our Steve Leisman for the very latest on this curious juxtaposition today, Steve, where we have failing banks, lifelines being thrown everywhere, and yet major central bank rate hikes. Steve, to be honest, I keep thinking back to 2008. Remember when the European Central Bank did that final rate hike into the crisis? And we'll see if they're repeating that this time around.
Well, Kelly, it's a day not to blink because you could certainly miss something of importance. U.S. markets trading with more confidence right now that the Fed is going to hike next week by a quarter point. Perhaps in reaction to this news Faber was just talking about, big banks coordinating a rescue of First Republic Bank, and also perhaps in reaction to a 50 basis point rate hike by the European Central Bank. That was not very badly received by markets, even perhaps taken well. Whatever the reason, the probability of a 25 basis point hike now at 83%. Just a 17% chance the Fed stands pat, a reversal, by the way, of the positioning of yesterday's trade. ECB President Christine Lagarde might have shown Fed Chair Jay Powell the way by what you could call a dovish hike this morning. Here's what Lagarde did. She hiked by 50. She backed off promises of future hikes. There's the dovish part. Insisted the banks are in good shape, and emphasized that there's a difference between the monetary policy tools and the financial stability tools, and she's going to use all of them, and she has the tools she needs. Of course, U.S. and Europe in somewhat different places. Take a look here. The inflation rate in the U.S. is 6% now, and it's been falling 8.5% and kind of flat in Europe. The policy rate also quite a bit above where Europe is right now, 4.63 in the U.S. versus 3% in Europe. While it may be too early to tell, there's also some differences in the banking issues, with the problem looking somewhat more tenuous in the U.S. among smaller banks. Europe right now, as far as we know, has just one big banking problem that maybe it's solved with that $54 billion. But the lesson from Lagarde to Powell is he does have the option. He can pull off a dovish hike instead of what you might call a hawkish pause. Kelly?
So, Steve, let me just recap. The headlines are coming fast and furious, which tells me that we are near the point of getting potentially a big announcement here. First, the Wall Street Journal reporting potentially 8 banks are involved with this lifeline to First Republic. Now there are reports on Bloomberg that these banks are in talks to provide First Republic with $25 to $30 billion in total. Sorry, that was the Journal. Bloomberg matched it. Obviously, David Faber was out there with this as well. So what does this tell you as we watch First Republic shares, Steve, rallying on this news and the nature of the kind of rescue we're talking about here? What you think? Janet Yellen has almost simultaneously to all of this been on Capitol Hill, saying the first time she heard of these problems at SFB was last Thursday. The question is, have they ring-fenced it now? Where do we go from here?
Yeah, I mean, that's part of what they're going to try to do here, Kelly. You're absolutely right. It looks like they've created this broad program. Program number one is what's happening at the Fed, the discount window over there, and the new fund that will take your collateral at par and finance it. That's one. And two is this idea of treating it bank by bank. And, of course, there's the other thing, which is there's this implicit insurance deposit. I don't know. I have to think there needs to be some caution on the equity here. If you don't know in this deal what happens to the equity, you're going to want to be a little bit careful here. But I'm just not familiar with how the equity is going to be treated here in this deal. It's
the major question as we watch these shares gyrate. Steve, thank you. And stick around, if you will, as you have been all day long. Steve's in Florida for a different reason, but he's holding down the Miami bureau there.